The HSA triple tax advantage that beats a 401k. Most people think 401ks are the best retirement account, but there's an account that's actually better, the health savings account. HSAs have a triple tax advantage that no other account offers: tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. Even better, after age 65, you can use HSA money for anything, penalty-free, just like a 401k. I'm about to show you why financial experts call HSAs the ultimate retirement account, and how to use them as a stealth wealth-building tool that could be worth $300,000 by retirement. The triple tax advantage explained. HSAs are the only account with 3 tax benefits. Tax Advantage 1. Contributions are tax-deductible. Every dollar you contribute reduces your taxable income. If you're in the 24% tax bracket and contribute $4,150, you save $996 in taxes immediately. This is the same as a traditional 401k. Tax Advantage 2. Growth is tax-free. Your HSA money can be invested in stocks, bonds, and mutual funds. All growth is tax-free. No capital gains tax, no dividend tax, nothing. This is the same as a Roth IRA. Tax Advantage 3. Withdrawals are tax-free for medical expenses. When you use HSA money for qualified medical expenses, you pay 0 tax on withdrawals. Doctor visits, prescriptions, dental, vision, Medicare premiums, long-term care insurance, all tax-free. No other account offers all 3 benefits. How HSAs beat 401ks and Roth IRAs. Let's compare $10,000 invested for 30 years at 8% average return in different accounts. Traditional 401k, $10,000 grows to $100,627. Withdraw at 25% tax rate in retirement. $75,470 after taxes. You paid 0 tax going in, but 25% coming out. Roth IRA, $10,000 of after-tax money. You already paid 24% tax, so you earned $13,158 and kept $10,000. Grows to $100,627. Withdraw tax-free. $100,627 after taxes. HSA, used for medical expenses, $10,000 pre-tax contribution, save 24% tax immediately. Grows to $100,627. Withdraw tax-free for medical expenses, $100,627 after taxes, plus you save $2,400 in taxes on the contribution. The HSA beats both. You get the upfront deduction like a 401k and the tax-free withdrawal like a Roth. The stealth retirement strategy. Here's the strategy most people miss. Use your HSA as a retirement account, not a spending account. Step 1. Contribute the maximum amount every year. The 2025 limits are $4,150 for individuals and $8,300 for families. If you're 55 or older, add a $1,000 catch-up contribution. Step 2. Invest the HSA money. Don't leave it in cash. Most HSA providers let you invest in mutual funds once your balance exceeds $1,000 to $2,000. Choose low-cost index funds. Step 3. Pay medical expenses out of pocket with other money. Instead of using your HSA for current medical bills, pay out of pocket with your checking account or emergency fund. Step 4. Save receipts for all medical expenses you pay. Keep every receipt, even if you don't use HSA money. There's no time limit on reimbursing yourself. Step 5. Let the HSA grow for 20 to 30 years. Your HSA compounds tax-free while you accumulate medical expense receipts. Step 6. Reimburse yourself decades later. In retirement, withdraw money tax-free using receipts from 20 years ago. The IRS allows this. There's no deadline for HSA reimbursements. Essentially, you're creating a second Roth IRA with higher contribution limits. Real example: $327,000 tax-free by age 65. Meet Sarah, age 35, with a family HSA contribution limit of $8,300 per year. Sarah's strategy: maxes out HSA every year from age 35 to 65, 30 years. Invests in S&P 500 index fund averaging 8% return. Pays medical expenses out of pocket, saves all receipts. Accumulates approximately $50,000 in medical receipts over 30 years. Results at age 65. Total contributions: $249,000. HSA balance: $1,020,000. Can withdraw $50,000 immediately using old receipts tax-free. The remaining $970,000 continues growing. After age 65, she can withdraw for Medicare premiums, long-term care, and any medical expenses, all tax-free. Can also withdraw for non-medical expenses penalty-free, just pays income tax like a 401k. Compare this to if Sarah had put that money in a 401k. $1,020,000 at 25% retirement tax rate equals $765,000 after taxes. She's $255,000 better off using the HSA. After age 65, HSAs become better than 401ks. Here's what most people don't know. After age 65, HSAs have all the benefits of a 401k plus more. Before age 65. Withdrawals for non-medical expenses equals 20% penalty plus income tax. After age 65. Withdrawals for medical expenses equals tax-free HSA benefit. Withdrawals for non-medical expenses equals income tax only, no penalty. Same as 401k. No required minimum distributions ever, better than 401k. So even if you never have medical expenses, unlikely, your HSA functions exactly like a 401k after 65, but you got to use it tax-free for medical stuff along the way. The medical expense reimbursement loophole. This is the strategy that makes HSAs incredible. You pay for a doctor visit out of pocket, $200. You keep the receipt. Your HSA grows invested for 25 years. At age 65, you reimburse yourself that $200 using the 25-year-old receipt. The $200 withdrawal is tax-free. The IRS has no time limit on HSA reimbursements. You can reimburse yourself for medical expenses from decades ago as long as the expense occurred after your HSA was opened. You have documentation. You didn't already reimburse yourself for that expense. People can accumulate $30,000 to $100,000 in medical receipts over a lifetime and withdraw that amount tax-free in retirement, even though the actual HSA money was invested and grew. Who qualifies for an HSA? Not everyone can have an HSA. You must have a high-deductible health plan, HDHP. 2024 HDHP requirements. Minimum deductible, $1,600 individual, $3,200 family. Maximum out-of-pocket, $8,050 individual, $16,100 family. If your health insurance meets these criteria, you can open an HSA. Check your health insurance plan documents or ask HR if you're on an HSA-eligible plan. You cannot have an HSA if you're enrolled in Medicare. You're claimed as a dependent on someone else's taxes. You have other health coverage that isn't an HDHP, like an FSA for medical, though limited-purpose FSAs are allowed. Your spouse has a healthcare FSA that covers you. How to invest your HSA. Most HSA providers offer investment options once your cash balance reaches $1,000 to $2,000. Common providers: Fidelity HSA, excellent investment options, $0 fees, thousands of funds available. Lively HSA partners with multiple investment platforms, low fees. Optum Bank, large provider, decent investment options, some fees. Health Equity, common employer HSA, okay investments, watch for fees. Choose an HSA provider with low or zero monthly fees. Good investment options: S&P 500 index funds, target date funds. No or low investment minimums. Easy online interface. If your employer's HSA has high fees, you can open your own HSA and transfer money there to invest. Common HSA mistakes. Mistake 1. Using HSA money for current medical expenses. If you can afford to pay out of pocket, do it. Let the HSA money grow invested. The tax-free compounding is worth more than the convenience. Mistake 2. Leaving HSA money in cash. HSA cash accounts earn 0.01% to 2%, invested in index funds earning 8% to 10% over time. The long-term difference is massive. Mistake 3. Not saving receipts. If you pay out of pocket, save the receipts. Even if you don't think you'll need reimbursement, having the option is valuable. Mistake 4. Contributing when not eligible. If you enroll in Medicare or lose HDHP coverage mid-year, you can't contribute for those months. Over-contributing triggers penalties. Mistake 5. Not maxing out the contribution. If you can max out 401k and HSA, max the HSA first. It has better tax treatment. Then, max 401k after. HSA versus FSA. Know the difference. Don't confuse HSAs with FSAs, flexible spending accounts. They're completely different. You own it forever. Money rolls over year to year. Can be invested. Triple tax advantage. Requires HDHP. Employer owns it. Use it or lose it by year end. Some plans allow small rollover. Cannot be invested. Only pre-tax contribution and tax-free withdrawal. No growth benefit. Works with any health plan. HSAs are far superior for long-term wealth building. What to do this week? Check if you have an HSA-eligible high-deductible health plan. If you don't, consider switching during next open enrollment if an HDHP is available. If you have an HSA already, check if you're maximizing contributions. If not, increase your payroll deduction to hit the annual limit. Log into your HSA provider and check if you're invested or just in cash. If you're in cash, move the money to low-cost index funds. Create a system for saving medical receipts. Use a folder, app, or spreadsheet to track every out-of-pocket medical expense. If your employer's HSA has high fees, research self-directed HSAs like Fidelity or Lively and consider transferring funds. Calculate what your HSA could be worth in 20 to 30 years at current contribution rates using a compound interest calculator. The number will motivate you. If you found this valuable, hit that like button, subscribe, and ring the notification bell. I drop new finance strategies every week that most creators won't tell you about. Also visit Own Your Finance blog for more in-depth financial tips and hacks, whether it's retirement strategies, tax optimization, investment accounts, and more. Don't forget to download my free guide, Finally Break Free from Living Paycheck to Paycheck, the simple 10-step budget that actually works, and start building real wealth today. Don't miss it. Thanks for watching and have a great day.